You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, we've been doing a lot with the airlines, and I think we're going to do another rinse and repeat. And I think I just want to go full circle with the trades. So one of the things that makes the airlines interesting is that implied volatilities are just crazy. We had just a couple, like even the professionals are confused about what's going on in the airlines overall and where we might be in the future and what airline travel is going to be about. As, for example, Warren Buffett bought Delta Airlines and then sold it about a month later for a loss, and then the stock came back up and started to skyrocket. Now it's back down. And then last week we looked at just doing a long put spread in an ETF, and that ETF was JETS. That's the symbol, JETS. That tracks most of the airlines. And we went that route because implied volatilities were too high to just do it in the individual option contracts. And then the week before that, Mark Longo actually came up with a new name for a trade that we were looking at. We did a long straddle, and we used two different airlines. So Mark and the people at Options Insider came up with the term a doppelganger straddle. Okay, so what we did was we looked at buying a put in one of the airlines and then buying a call in a different airline, just trying to guess which one might have a little bit more upside versus downside. That straddle did work out, but one of the things that we talked about on that episode of Options Playbook Radio was that the implied volatilities were high, but they were not as high as they are right now. So long straddle was interesting. It was looking still for a very large move. We could buy two at-the-money option contracts, I think, with over 20 days remaining to expiration, and the total long straddle was about $5. So that trade actually worked out on the upside and on the downside if you wrote it out, in that the market went up enough on the long side, the call side, that it actually paid for the long straddle and then some. There were many opportunities could have gone out for a gain. And then on the downside, the market right after it made a big run up, made a big run down. And now we have still crazy implied volatilities. Now, at the end of July, we're coming into some earnings. Today's stock, we're going to deal with an extremely volatile stock. It's going to be United Airlines. And they came out with some major news today, so why not talk a little bit about them? I think the opposite is true. We talk about on Options Playbook Radio when strategies might work based off of the market conditions, not necessarily the outlook on the underlying. So, because we're not here to talk about recommendation, we're just here to talk about strategies. We have over 40 different plays inside the Options Playbook. So we get creative with our plays and we have some fun with them. But I don't think we can say we've had as much fun as we did when we talked about the long doppelganger straddle in the airline stock. So that was one of the more fun trades that we've ever done on Options Playbook Radio. So today I'm going to continue with that theme. Now that implied volatilities are so high, I'm going to look at a skip strike butterfly, and I'm specifically going to use an airline that has extremely high volatility relative to the rest of them, and that's United Airlines. They're all up over 100%, but right now if I look at a 30-day at-the-money volatility for UAL, that's actually at 120% implied volatility. Now, they haven't announced when they're going to announce earnings, which is just kind of scary overall, trying to figure out what might get said at any of their earnings. And we're going to avoid that time period. So to 100% avoid it, we're going to look at doing our skip strike butterfly on the July 2nd expiration. Earnings should be at the end of the month, but from even looking at the change, it's hard to discern when that earnings might be anticipated. The information wasn't available on the investor relations website of UAL. Many different sites that I went to all had different dates, so we're just going to avoid it completely. We're going to look at a short-term call butterfly. It's going to be out of the money. And part of the reason why we can go short term like this is that these implied volatilities are just so high, and it doesn't necessarily matter what expiration you're looking at. So on the July 2nd expiration, we have 15 days remaining, so it does give you some time. And if people are looking at doing short call spreads or short put spreads because of the high implied volatility, that's just a tough trade to pull off. Something where you're pulling in 50 cents maybe on a 3-point wide spread, going one standard deviation out of the money is just a scary trade to be in. There's really no protection to that trade, and if it goes against you, it's going to go against you hard. United today announced that they're going to require masks on their planes going forward for the near future, and we just don't know what's going to go on. So here's the trade. Here's what we're going to look at. We're going to go 15 days out to the July expiration. We're looking at a skip strike butterfly, which means we're going to sell a way out of the money credit spread when it's all said and done to pay for a normal standard butterfly. So at that expiration with 15 days remaining, we're going to buy the July 46 strike call and then sell 2 of the July 2nd 49 strike calls. Normally, we would come back and we would buy the 52 strike call as a hedge. That would be a standard butterfly. But we're going to skip that strike and we're going to buy the 55 strike call. Obviously, that's going to make that call option and that insurance a lot cheaper, but it's also going to make the max risk higher in that we're embedding this call spread in here, this short call spread, and that's going to add 3 points or make our max risk $300 less the credit received. And yes, I said credit. Right now, with the markets closed, we're taping Options Playbook Radio at on the 17th of June. This is trading for a 43-cent net credit to the account. All right, that means for every 1 by 2 by 1 skip strike butterfly that you do, you're going to bring in $43 less commission on that trade. Now, what else does that mean? That means that our maximum upside, if the stock were to close at expiration at the 49 strike, just like a standard butterfly, you'd like it to close right at your strike, right at expiration, you can make that $3 plus you can make the 43-cent net credit. So the maximum upside is $3.43. Now here's the bad news though. We have embedded this credit spread. That means that we could also lose that $3. So our risk kicks in at the expiration between 52 and 55, that strike that we skipped. If it ended up going all the way above 55, which would be 15 points higher than where it's currently trading at, we would get it would cost us $3 minus the net credit received of 43 cents, or our maximum risk would be $2.57. Now, the most interesting fact is that if the market just stays where it's at or goes down, all the options would expire worthless at the expiration 15 days from now, and we would keep that net credit of 43 cents. So we have three scenarios where this trade is okay. Now, this is waiting up until that expiration date. Scenario one is the market goes down. Scenario two is that the market stays where it's at. Scenario three is where the market kind of goes up and finishes in between, the ideal scenario where it would finish in between our long 46 strike call and our two short 49 strike options, because then we'd not only get the net credit, we would get some benefit of the long call. And our worst case scenario would be if the market skyrocketed up and ripped through all the strike prices and finished above the 55 strike call. Then we would have that maximum loss. Now, this trade is interesting. When you first put it on, your ideal scenario is that you really get a couple of days of time decay, because if it does start going towards your short strike right away, it is going to hurt a little bit. You need time decay to set in before you really start seeing the benefits of the butterfly and it actually paying you out closer to that expiration date. But now this is just an interesting way for me to do this, because I know some people out there are thinking about selling some of this vol premium. And the news headlines just make it really tough to do that without having the potential to hedge yourself on a trade like a skip strike butterfly. So if I'm looking at that trade, let's say the alternative here, let's say we came in and we just sold that strike that I was talking about, the 52 strike, and then bought the 55 strike. So we just sold the 52, bought the 55, which is basically the spread that's helped paying for our butterfly here. If we did that trade, you could bring a net credit to the account of about 87 cents, almost double what the credit would be as compared to the skip strike butterfly. But the downside is you have no protection if the market goes against you. So yes, you do make double the credit in theory. Now, once again, the markets are closed, and so they're not quite as tight as they would be if the markets were open. But in theory, if I went and just did this short call spread, the one that we're embedding in our butterfly, we would earn about double. We'd have the potential to earn about double the net credit to the account, but we would need the market to go down or stay the same. If it drifted upwards a little bit, it would work harder against us than the skip strike butterfly. Okay, so it's an interesting alternative. So if you're thinking about doing short call spreads or short put spreads in any extremely volatile stock, this is an interesting trade as an alternative to do, because it does give you that ability to earn that net credit, but it also protects you if the market goes against you. Now, it doesn't 100%, it's not a perfect hedge, and I don't think there is such a thing as a perfect hedge, where you want it to go both directions no matter what. You need it to go towards your short strike, closer to the expiration on the skip strike butterfly. But it does give you some security by doing the butterfly as opposed to doing the short spread. So let's summarize this, okay? It's a tough concept to follow, but we do not want to be in during earnings. We're avoiding earnings, and there's no reason to even think about earnings because the volatilities are so high without that known news event. So we're going to go to the July 2nd expiration. It's 15 days away. We're going to buy the 46 strike call. Then we're going to sell 2 of the 49 strike calls. We're going to skip the 52 strike call. That would be the standard butterfly. And then we're going to buy the 55 strike call. The midpoint with the markets closed is at a net credit of 43 cents to the account. United Airlines closed today at $39.25, down 96 cents. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. And I want to make you aware of the fact that we're going to be having a digital conference at Ally Invest. It's going to be on the Ally YouTube channel, and it's going to be all day long, and it's going to be starting on the 26th of June, so next week. So make sure you check out the Ally YouTube channel for our Ally Invest digital conference. Thanks for coming, everyone.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.